Dividend growth is one of the most important factors to analyze for long-term dividend investors. Consistently high dividend growth will compound your income over time, giving you a fantastic starting yield on cost. In this video, I'm going to discuss 5 fast-growing dividend stocks that I'm looking to add to my long-term dividend growth stock portfolio. All have seen over 15% dividend growth in the past year. I currently own 2 of these companies, and 3 I've never discussed on the channel before. In my opinion, each of these stocks are poised for reliable, high dividend growth in the foreseeable future. With that said, let's analyze some stocks. Roll the intro. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout this analysis, I will be using my research software available at dividenddata.com. This tool not only lets me track my dividend portfolio, but conduct in-depth research on over 8,000 stocks. You can sign up at the link in the description. There is a 30-day money-back guarantee, so no risk in trying it out. If you have the software, you can follow along and research some stocks with me. First, we have KLA Corporation, stock ticker KLAC. Their most recent dividend increase was a whopping 23.81%. This is a company I had not heard of until I started doing additional research into the semiconductor industry. They are a supplier of industry-leading equipment and services for semiconductor manufacturers, so their customers are companies like Taiwan Semiconductor, Samsung, and Intel. I've found that there are a lot of hidden gems lower down on the semiconductor supply chain. KLAC is currently valued at $52.8 billion, with 141.8 million shares outstanding, giving it a price per share of $372.39. The PE ratio over the trailing 12 months is 17. This seems fairly valued based on the high growth rate of the earnings. The forward-looking annual dividend is $5.20, giving it a 1.4% starting dividend yield. The financials are very impressive. Everything is growing at a high rate. Over the past 10 years, annual revenue has grown from under $3 billion to $9.2 billion. Earnings per share has grown from $3.27 to $22.07. And free cash flow has grown from $800 million to $3 billion. If we look graphically on a per share basis, it's so impressive. The revenue per share has exploded, and over the past 5 years, the compound annual growth rate is 22.44%. In the fiscal year 2022, they grew revenue by over 36%. Free cash flow per share has seen even more significant growth. The 5-year compound annual growth rate is 24.58%. The 3-year CAGR is 45%. And in 2022, free cash flow per share grew 57.53%. This is very strong growth. 2022 free cash flow per share was $19.97, giving it a free cash flow yield of over 5.2%. This is a very important factor to analyze because dividend payments are downstream of free cash flow. KLAC also has very high margins with 60% gross margins and 30% net margins. In fiscal 2022, their annual net margin was 36%. With their strong free cash flow, they've bought back shares and paid a fast-growing dividend. In fiscal 2021, they reduced their share count by 1.63% and in 2022 by 2.5%. This increases your relative ownership stake in the business. The stock's dividend payment has grown at a 14.5% 5-year compound annual growth rate. Their most recent increase was 23.81%. Prior to that, they had a 16.67% dividend increase. The best part is that this dividend growth seems sustainable. The current payout ratio is 20%, which leaves plenty of room for them to reinvest in the business and grow their dividend over time. If we look at their cash flow statement, you can understand this in more detail. In fiscal 2022, they generated $3 billion in free cash flow. They paid out $638 million in dividends. The dividend payment seems very safe with room to grow, especially considering the growth of their free cash flow. I'm definitely considering adding KLAC stock to my long-term dividend growth stock portfolio. I would like to do a deeper dive into their business model though. One detail to be cautious of is their historical earnings have been slightly cyclical. This is most pronounced during recessions since that likely decreases spending at semiconductor manufacturers. However, I'm not sure whether this risk will be experienced anytime soon. So many new semiconductor fabrication plants have been announced to be built over the next few years. This is a huge tailwind that will likely help KLA's business significantly. Also, in my brief analysis, it seems like they've expanded more into services, which may have helped provide more consistent earnings. Stock number 2 is Visa, stock ticker V. Their most recent dividend increase was 17.19%. This is a company I own and view as extremely high quality. Visa is the top digital payment network in the world. Please check out my full stock review video for an in-depth look at their business model. Visa is currently valued at $450 billion with 2.1 billion shares outstanding, giving it a current price per share of $213.40. The PE ratio over the trailing 12 months is 31, which is high, but you have to price in the reliable future growth. The forward-looking annual dividend is $1.50, which gives it a starting dividend yield of 0.7%. Here you can see Visa's non-GAAP earnings per share, which are growing at a high rate. They are fully recovered and growing from the pandemic shutdown-induced dip. Revenue per share is growing at a 15% 10-year compound annual growth rate. Free cash flow per share is growing at a 20.37% 10-year compound annual growth rate. Their margins are crazy good with 80% gross margins and 50% net margins. Visa basically prints money and has huge growth drivers behind it as more payments become digital. In the latest quarter, Visa generated $5 billion in free cash flow. Their business model requires very little capital expenditures to fuel growth, so they are able to pay a fast-growing dividend and reward shareholders with massive stock repurchases. In Q3, they paid out $800 million in dividends and repurchased $2.4 billion in stock. Their shares outstanding are reduced by 1 to 3% every year. Visa's dividend has grown at a 24.86% 10-year compound annual growth rate. Its 5-year CAGR is 17.5%. Their latest dividend increase was 17.19%, and they are due to announce another increase in the coming months. This dividend is extremely safe with a 20% payout ratio, meaning future growth will likely continue to be high. Now I know what some of you may be saying, the starting dividend yield is so low at 0.7%. Well, historically, the starting dividend yield for Visa has almost never been over 1%. However, because of dividend growth, if you bought Visa in 2010, your dividend yield on cost would be over 9%. That's pretty awesome considering the company still has so much future growth ahead. Stock number 3 is Union Pacific Corporation, stock ticker UNP. Over the last 6 quarters, they've had 3 dividend increases over 10%. That is crazy for something often thought as a boring business. It turns out that this railroad company is thriving. Their earnings have been growing at a reliably high rate. Union Pacific is currently valued at $150 billion with 624 million shares outstanding, giving it a current price per share of $239.11. Their PE ratio over the trailing 12 months is 22.28, which is reasonable. Their forward-looking annual dividend is $5.20 per share, which is a starting dividend yield of 2.17%. Revenue per share has grown at a 6% 5-year compound annual growth rate. Free cash flow per share has exploded over the past decade with a 12% 10-year compound annual growth rate. It's a high-margin business with 45% gross margins and 30% net margins. Their operating cash flow in fiscal 2021 was $9 billion. However, their free cash flow was $6 billion due to large capital expenditures. Given the physical nature of their business, they obviously require far greater capital expenditures than a company like Visa. And there's not necessarily anything wrong with that. Union Pacific pays a fast-growing dividend and has had massive stock repurchases. They've been buying back stock at an insane rate, even using debt to fund this. I'm sure they would argue they were taking advantage of the low interest rate environment. Over the past 5 years, they've been growing their dividend at a 16.45% compound annual growth rate. These 3 recent 10% increases are crazy high growth for this kind of company. It is outside the historical norm. My intuition is it will slow down in the coming years. The current dividend payout ratio is 42%, which is definitely sustainable. However, this is higher than all the other stocks we're looking at today. I do think that UNP will likely have slower future dividend growth, but the starting dividend yield of 2.17% is nice for income-focused investors. I have two more stocks to analyze in today's video. One is a company that I own and have covered on the channel. The other is a fast-growing semiconductor stock that I've never mentioned before. But first, a message from our video sponsor. If you are looking to diversify your portfolio, you need to hear about today's sponsor, Masterworks. Billionaires have been quietly diversifying their portfolio with art for years. Now, Masterworks allows investors like me and you to as well. Masterworks is democratizing the art market by allowing anyone to invest in high-value works of art. Masterworks lets you invest in multi-million-dollar paintings by Picasso, Warhol, and other world-renowned artists. They securitize the art and then file an offering circular with the Securities and Exchange Commission. When Masterworks sells the art, you get your portion of any proceeds the painting generates. Masterworks has sold 5 paintings since 2017 with an average net return of 26.8% to investors. Contemporary art prices outperformed the S&P 500 total return by 164% for the past 26 years. There's currently a waitlist to sign up, but with my code, you can skip the waitlist and start investing today. By investing with Masterworks, you will diversify your portfolio and join 250,000 people who have already signed up for Masterworks. Check out the link in the description to start investing today. Thank you to Masterworks for sponsoring today's video. Now let's get back to the topic of the day. 5 fast-growing dividend stocks. Stock number 4 is Kroger, stock ticker KR. Kroger's most recent dividend increase was a massive 23.81%. This is a company I own and have made full stock review videos on in the past. Kroger's non-GAAP earnings per share have grown at a high rate, especially in recent years. They are currently valued at $35 billion with 715 million shares outstanding, giving it a current price per share of $49.76. The PE ratio over the trailing 12 months earnings is 17, which is very reasonable considering their growth rate. The forward-looking annual dividend is $1.04, which is a starting dividend yield of 2.09%. Kroger grows their revenue per share at a high 10% 10-year compound annual growth rate. They have a very low price-to-sales ratio of 0.27. That is because, unlike the other businesses we've analyzed today, Kroger is a low-margin model and makes its money through volume. This is very common in the grocer and retailer business model. Kroger's free cash flow per share has grown at a 14.5% 10-year compound annual growth rate. If we look at their cash flow statement, Kroger generated $6.1 billion in operating cash flow over the last fiscal year. However, their free cash flow came in at $3.5 billion. Similar to UNP, their business requires more capital expenditures. This includes opening new stores, investing in their supply chain, and building their new automated online fulfillment centers. All this will help fuel future growth. Kroger uses their free cash flow to pay a growing dividend and repurchase large amounts of stock. Here you can see their rapid decrease in shares outstanding since 2000. Kroger's dividend has grown at a 13.64% 10-year compound annual growth rate. Every year, they have reliable dividend growth. They recently announced a 23.81% increase, which is huge. In the year prior, they had a 16.67% dividend increase. Their payout ratio is 35% based on net income, but around 20% based on free cash flow. Kroger has plenty of room to grow the dividend at a high rate moving forward. Stock number 5 is Lam Research Corporation, stock ticker LRCX. Their latest dividend increase was 15.38%. Similar to KLAC, this is a company I recently discovered in my semiconductor industry research. They are a leading supplier of high-end semiconductor processing equipment used in the fabrication of integrated circuits. Their earnings have exploded over the past few years. Lam Research is currently valued at $65 billion with 136 million shares outstanding, giving it a price per share of $478.33. PE ratio over the trailing 12 months earnings is 14.61, which is quite cheap for a company growing at the rate of LRCX. The forward-looking annual dividend is $6, which is a starting dividend yield of 1.25%. Lam's revenue per share has grown at a 20% 5-year compound annual growth rate. Their free cash flow per share is growing at a 19% 10-year compound annual growth rate. At the end of fiscal 2022, their free cash flow per share was $18.25, giving them a free cash flow yield of over 4%. They have 45% gross margins and 26% net margins. The company generates significant free cash flow with not too high of capital expenditures. In recent years, they've started buying back significant amounts of stock and paying a growing dividend. LRCX started its dividend payment in 2015. Since then, the management has demonstrated a willingness to increase it on an annual basis. Over the past 5 years, the compound annual growth rate of the dividend is 27.11%. Their latest increase was 15.38%, and they're due for another increase anytime now. The dividend payout ratio is very low at 17% based on their net income and 30% based on free cash flow. Their dividend seems very sustainable and poised for growth over the long term. Of course, this growth will be dependent on their future business performance. Similar to KLAC stock, their business has had historical ups and downs. I assume this is dependent on the demand for new semiconductor equipment, which can change under various market conditions. However, it seems like their products will be in high demand in the coming years. More and more semiconductor fabrication plants are being built, which will mean more equipment is needed. Let me know if you'd like a deeper video diving into the business model of these semiconductor companies I discussed today. Currently, I own 2 of the stocks discussed today in my long-term dividend growth stock portfolio. However, don't take my advice blindly and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to use my software and join a Discord community of like-minded investors. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Please leave a comment below, and thank you for watching.